Hey traders, this is Ron Haydat Market Tamer. Happy Sunday. Hope you guys are having a fantastic holiday season. I just got back from vacation on Saturday, so we'll get back to a more regular schedule of these nightly videos. Did have fun in Vegas. It was the busiest I've actually seen it in years over the holiday season. Before we go any further, let me just pop up the disclaimer. Nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues shall always be addressed with your financial advisor. In Thursday's video, which was the last video I did, it was intraday, the markets were getting hit hard. And by the time I finished the video, a rebound started. And man, in that last hour of the day, we had an immense rally. Now, if only I could see that coming every single day when I did a video, it'd be a lot more fun and interesting. But in all seriousness, I did get some questions on, with the rally Thursday, Friday, what do we see going into the last trading day of the year tomorrow into the next week? And the comments from my Thursday video still hold. All those points are still important. So let's do a quick drill down. We'll do the diamonds, spiders, Qs, IWM, MDY, and we'll take a look at Amazon and Apple as well. And there's some really interesting things, whether we look at weeklies or whether we look at dailies. So first off, Dow, ETF, DIA. 2-year chart, you can see the plunge starting in December really took hold. And I talked about watch if we lose those lows. We talked about that before. This was the next area. And once we lost this was a quick, from the breaking point, about 1,000 points in the Dow. It happened really quickly. Now, since then, we had the day after Christmas rally. Thursday, we had the sell-off and the reversal. And then Friday, we tried to rally and then closed down a little bit. Now, the blue line is the 5-day EMA. So if I were to ask you a question, are we above or below the blue line, you would say, hey, we're above it, right? That means the 5-day trading outlook is bullish. That is it. We are still below the 20 period in red and the 50 and 200. Even those two are crossing. You're going to hear about the death cross now galore. That'll make for some nice headlines and emails. But we're still below all these moving averages. There's still been quite a bit of damage done. If I take a look at the spiders to your daily, let me zoom in. There's the rally. We're on top of the 5-day. 5-day outlook bullish. Once we blew through this previous support area, we dropped like a rock, went from about 253 down to 235, 170 S&P points. Still bearish on the week, still bearish beyond 5 days. Only the 5-day period here is up. I'm just trying to drive this point home about the Qs. Blew through some support there around 153, 155, down at 145. We're rebounding. If I zoom in, we're above the blue line. You get the idea, but we're still below all the others. And the same holds true for the IWM and the MDY. But man, just look at the IWM. This is a 2-year daily. We were up in the low 170s. Now we're down in what was the mid 120s, low 130s. We're still playing with some daily support down here. Everything beyond 5 days is bearish. So yes, nice big rally the day after Christmas and Thursday. But really, nothing technically has been done to change the picture. We are still bearish. Caution is still warranted, and the bears are definitely in control. Now, watch what happens. If we go back to the diamonds, and I bring in a weekly chart. 5-year on the weeklies. This was that support area that I had drawn in on the dailies. We broke through that. When I zoom in, look what this candle, this is a weekly candle. We got right back up in there and we stalled. You see the top side there, that tip of that candle? We got back up into it and we were instantly rejected. This is not a good sign if you're a bull. If we could have gotten back above that, that puts a new line in the sand. We couldn't. So what was once support is now resistance. The next support level for the Dow ETF on a weekly basis, it's Dow 20,000. 3,000 points lower than where we are now. 30 diamond points. That is not good, right? So let's take a look at the SPY. If I zoom in here, this was the old support zone. We barely got back up into it. I mean, maybe at the absolute top of that candle on Friday, maybe we were able to touch some of these previous lows. The S&P, if we compare it to the Dow ETF, the diamond, it's a little weaker, and its target is much closer. The 200 period is right now around 226. So it's not as far off in terms of distance as the diamond support, but that would still be a target. And nothing says the Dow is going to drop to that 200 period average. So if I go back to the DIA, nothing says we're going to get down here. I'm just telling you that's where the next major support lies. It just is what it is. On the spiders, that would be support here. Now the S&P 500, it's 500 companies. It's broader than the Dow. I would rather watch the SPY and say, okay, if we get down to that 200 period, that would require new lows, and we're about $20 lower on the SPY or 200 S&P points. If I bring in the Qs, I think the Qs of the three majors that we're currently looking at has the best head and shoulders. This is the left shoulder. Up there is the head. Here's the right shoulder. Here was support. And if I zoom in here, I can even draw it for you, and I can show you how. Just draw something like this. I can show you how that old bar, like on the Dow, was support. Now it's resistance. Look what's happening here on the Qs and the weekly. We got right back up into there, just like the Dow. Not looking good. Downside target would be 130. Now, just for sort of a game of horseshoes, if you take about 185 down to 160, that's about 25 points. Take 25 points below 155, get down to about 130-ish area. That's right around where the 200 period is. So if the Qs live up to their head and shoulders target, interestingly, it's down there. You can still see between the three majors, there's definitely downside room. There's room on the downside before we hit that next support level. And I am not blown away by this post-Christmas rally at all from a technical perspective. Now, if we go to IWM, which is the mid caps, again, up here, they've already cracked their 200 period. They tried to get back above it. They sort of failed. If I zoom back out a little bit, where's their next support? They're sort of teetering on it. Otherwise, you come all the way down 115-ish, and then major support maybe around 108, 110. Everything lines up for potentially further selling. If I go to XLF, this is the bank ETF. Check this out. Weekly chart, the 200 periods in purple. We tagged that last week and we held it, which was previous some support here, back test support, which then led to a really nice about 7-point rally, 30+% in the XLF from around mid 2017 up into the early part of 2018. The banks had a great run. We're back down there. So it took, you could say, half a year, only took about, a month and a half to lose. If we break the weekly lows from this past week, you're then talking about something at 19. It's over a 10% drop in the banks. We look at the IYT. These are your transports. Similar to the banks, they are at their 200 period. They're clinging to support from 2017. If that falls, you go back down to the last consolidation point. That's around 140, 20 plus points lower, talking maybe 12 to 15% potentially lower than where we are right now. Just keep it on the 200 period. And really, for all the major averages, we need to watch this past week's lows. Before we do that, let's actually take a peek at Apple and Amazon. We'll finish out the individuals, and then I'll give you guys a summary. So here's Apple weekly chart. Had a nice bull flag up there. It broke down, and then it went straight down. If the 200 period can't hold on Apple, which is going to tie in with maybe a little bit of support at 140, if you're an Apple bull, hold on to your hats, because the next major support area is somewhere maybe, I'm going to say between 100 and 110. And then massive support, I would say, down at 90. If I switch Apple to a daily chart, and we zoom in, zoom in from here to here, you'll notice there's a little bit of a gap from February of 2017. That's right around 120. So if we take out the lows from last week, 120 is the target. And if I zoom out further, that's where you can see these other little pivots down here towards 100. That's a long ways off. So 36 points lower right now 36 points lower for support, and then down here. Now, if you notice, we're going to have earnings season coming up in about 2 weeks. Alcoa will start getting things started. Looks like Apple's due to report at the end of the month. There could be back and forth between then. The earnings report could send it down. You never know. But the point is, between now and then, I could easily see this just becoming another semi-crash and then a rally back up into earnings to see where it's going to end up. I would say the first 2 weeks of January here could really be dicey. And here's Amazon. This is going to be a 5-year daily chart. A little bit of a double top up there, just over 2,000. We're trying to cling to support here around 1350. The next major support for Amazon, I could ballpark it and say $1,000. Like, wow, 400 plus points lower. That's the potential. If I change this to a weekly chart, left shoulder, head, potentially right shoulder, depending where you draw the neckline, that also puts you somewhere down here. There's a little bit of a pause around 1,200. So the bulls would be maybe clinging to maybe 1,200 support, otherwise down towards 1,000, which is where the 200 period comes in. No matter what we're looking at here, things do not look good for the bulls, which brings us into what's the outlook for the year ahead. If I could be that amazingly spot on every year, it'd be a really, really great gig, right? Nobody can predict where anything's going to go. We can have our best guesses. Based on, if I take you back to the S&P and take you back 10 years, now every candle's a month. This was the last crash in '08. I personally think we're going to go back to new highs and maybe way higher, potentially, if things sort of hold together. The stuff that's happening right now is really no different than the stuff that was thought that could have happened back before the market turned down. But now the market's paying attention. There is not incredible volume. In fact, I'm blown away at the lack of heavy volume on the selling side. However, you could be a perma bear, I could be a perma bull, and I'm neither. I am just, I trade what I see. I can have my opinions, but what you see is what you get. And right now the markets are bearish. I am looking to put on a new bullish position, but not yet. I did not see capitulation yet. It just hasn't happened in the sense that the way it's happened in the past. So if I'm walking into the first week of the new year, and what do I see? The monthly is bearish on the S&P. The weekly is bearish on the S&P. And frankly, if I go to dailies, the dailies are bearish except for the 5 period. This, to me, is a pathetic bounce. So I do think we're going to go back, either we retest or break the lows just on basic, simple technical analysis. If there is a continued rally, this would be the rally point on the S&P, no matter what you're looking at, the last major consolidation. But if I zoom out and zoom back in here, we also had lows here. This would be the first target, actually about 253. Then up to about 262, 261. If we hit either one of these, we roll over and volume picks up and it exceeds the rally days. That is a really bad sign. That's a backtest fail rollover. We never got, as I said in my Thursday video, bullish engulfing. We didn't get a hammer. We're missing that. So those are the things I'm going to keep an eye out for. In the next video, we're going to talk about gold and silver because we talk about how they are seasonally bullish this time of year. Typically, GLD has already started its move once it got above the 200-day, which was back just before Christmas, and it's starting to push higher here. So we'll talk about that as well. So whether the market is bullish and bearish to start the year, from a seasonality perspective, there's stocks that trend down, there's stocks that trend up. Those are the ones I want to focus on and not just guessing at which ones typically might go higher or lower, because the big money is what pushes them. So think about this. If the big money is pushing stocks down, even when the market typically is bullish, which it is in January, to me, those have even higher probability of going down. So instead of wondering what might drop, I'll pick the ones where the money typically leaves them, i.e. it's selling, and then maybe go find ones that it's going into. So bullish or bearish, well, we can still find trade ideas. I mean, gold, typically bullish. It rallied about a week ahead of schedule, just like it did, I think it was a year ago. In fact, now we're starting to dig into it. But yeah, here, last year, it started clearing some moving averages right around the 20th, 21st, 22nd, right around Christmas. This year, started a couple days earlier, you could say, and it's up about maybe $2 from breakout point. But again, we'll talk about that in the next video. So in summary, I wish you and your families a wonderful New Year's Eve and New Year's Day. Look forward to a fantastic year of trading together. And you guys keep loving these videos, so I'm going to keep doing them. So I hope you do find them helpful. When you do write in via email or post a question, I'll try to address it. Remember, it's always from an educational perspective. I can't tell you what to do. I'm not a licensed financial advisor. But it's been a lot of fun. And again, I wish you guys all the very best. Happy New Year. Bye-bye.